Hello, everybody. Welcome to IRA Planning for Boomers. I see some of you on this list are younger than boomers, but this is going to be great information regardless. I'm Betsy with Elevate Wealth Advisory, and I'm very excited to introduce you today to our founder, Chuck Vickery. Chuck founded our company in 1982 as Vickery Financial Services. And since that time, we have grown now to a team of 11 people as of Monday. And we are continuing Chuck's goal of helping people make smart decisions with their money. And Chuck is here. He's one of the wisest people I've ever met, and he's able to break down complex subjects into things that we can understand. And I'm so happy to have him here with us today. Hi, Chuck.
Hi, Betsy. So I just want to say hello, everybody, and welcome. Thank you for attending this webinar. We call this Savvy IRA Planning for Baby Boomers. And we know a lot of people have been accumulating money for retirement, but far too often that's where the planning stops. So maybe that's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement, is just important, if not more so. So most of the time when you discuss retirement planning with someone, they are still working. Well, I am mostly retired. We'll call it semi-retired. So today you're going to hear from a retiree on some things you should be paying attention to when you retire. So maybe a little different. May throw in a few things that you may not expect. But a major objective of Elevate Wealth is to give you the tools to live your best life. And our goal today is to review some of those tools, especially as they relate to retirement accounts. Now, at the bottom of your screen, you may see a little Q&A button. So as we go through this, if you have any questions, just click that, type in your question, and when we get through, we'll come back and answer any questions that anyone has. So we get lots of questions when it comes to IRAs and other retirement accounts, like how my withdrawals taxed? When do I need to begin taking these withdrawals? How much will I have to take? And what happens to my IRA when I'm not here? And perhaps more importantly, how can I minimize my taxes so I can spend more of my hard-earned money? Well, let's dig into that a little bit. Many years ago, many retirees lived comfortably on pensions and Social Security benefits, and maybe they had some other savings or some investments, but that was enough. So today, though, companies and other organizations have basically abandoned pensions, and they've abandoned them in mass numbers, and instead they've turned 401ks and similar plans, shifting the risk that they once shouldered onto the backs of their employees and their families. And now retirees are responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with all the changes to the tax law. And those are frequent. For example, we recently had the Secure Act 2.0 that made almost 100 changes to the rules of retirement accounts. So the bottom line to all this is that today, more than ever, when it comes to your retirement, you're on your own. On top of that, your savings will probably have to last a lot longer than you think. According to the Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 or more years. So look at this chart and you'll see what I mean. If you're a man and you're 65, you have a pretty good chance of living to age 85. If you're a woman and you're 65, you have a better chance of living than you do of dying. And if you're married and both of you are 65, there's a strong chance that at least one of you will live to be 90. Look, 62% chance one of you will make it to 90. And a 33% chance of one of you will make it to 95. So that's probably much longer than a lot of you considered. And you put all this together and it makes planning that much more important. So as you get late in your work career, one of the best things you can do as you approach your retirement is to beef up your retirement savings by contributing as much as you can to tax-favored retirement accounts. Although contributing at younger ages is more powerful because it gives your contributions more time to compound, you may have been able to save as much as you wanted because you were bogged down by mortgage payments, you were educating your children, or you just had other expenses associated with raising a family. I know the biggest raise I ever received is when my oldest daughter graduated from college and my youngest daughter transferred from Ole Miss back to Georgia and got on the Hope. About 6 months after that, I looked at my checking account and it was full for the first time. It was overflowing simply because all of a sudden I had discretionary money. So when you have that discretionary income, it can be used for your retirement funding. So how much can you contribute? Well, that depends on the type of retirement plan as well as a number of other factors. But let's just begin with traditional IRAs. A traditional IRA or individual retirement account is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside the IRA, it grows tax deferred. Ultimately, when you take that money out of the IRA, it's taxed and it's added to your income. So that's the IRA. Contributions may be deductible. There's tax deferred growth, and you'll pay tax on it when you take it out. So how much can you put in? For 2024, the maximum contribution is $7,000. However, if you're going to be age 50 or older by the end of this year, you're allowed to make an additional $1,000 catch-up contribution, and you can contribute for 2024 up to $8,000. You can't always make a traditional IRA contribution, though. For instance, you must have what the tax code refers to as compensation. For most people, compensation is earned income, but it does include taxable alimony as well. It does not, however, include things like interest, dividends, capital gains, Social Security, unemployment compensation. So most of the time, if neither you nor your spouse work, you will not be able to make a traditional IRA contribution. However, there used to be an age limit that said you could not contribute past 65. And the Secure Act 1.0 changed that and did away with the age limit. So for the last 5 years, anybody of any age that has earned income can contribute to an IRA. And traditional IRA contributions are deductible unless you or your spouse are active participants in an employer-sponsored retirement plan and your income exceeds a threshold amount. And these limits depend on your filing status and who is contributing to the employer's plan. So for 2024, the threshold, so you can still make a deductible contribution for a couple, you make a full deductible contribution if your income's $123,000 or less. If it's above $143,000, then you're not allowed to make any deductible contribution. And in between those two, you make a partial deductible. If you're single, it's income less than $77,000, and then that phases out at $87,000. If your income is between $77,000 and $87,000, you make a partial deductible contribution. And these contributions can be made as late as April the 15th. Now, don't wait that late to make one or to set up an IRA, but when you're doing your tax return, you might ask your tax preparer, hey, am I eligible to make a deductible IRA contribution? Many of you probably know there's another type of an IRA, and it's called a Roth IRA. And Roth IRAs are similar to traditional IRAs in many ways, but there's some key differences. One of those differences is that you do not get a tax deduction when you make a Roth IRA contribution. You're using what we call bread and milk money, or what I call bread and milk money. When you go to the grocery store and you buy bread and milk and other groceries, you're paying for that with money that's already been taxed. When you put money into a Roth, you're doing that with money that has already been taxed. But once your money is in a Roth IRA, like a traditional IRA, it grows tax deferred. The big benefit of the Roth, though, and another key difference, is that Roth distributions can be tax-free in retirement. There's no tax on the interest. There's no tax on the dividends. There's no tax on the growth. There's no tax on the withdrawals. There's no tax to you. There's no tax to your beneficiaries. Okay. So to qualify for that, the money has to have been in the Roth IRA for at least 5 years, and you have to be age 59 and a half. But even if you need to make a withdrawal from a Roth IRA and you don't, it's not qualified, had been in there 5 years or over age 59 and a half, you can always take out what you put in. Absolutely tax-free. And there's some rules on Roth IRAs. They're similar to traditional IRAs. 7,000 if you're under 50, 8,000 if you're over 50. You must have compensation, generally earned income. There is no age limit. However, there are income limits. So single filers can make a full Roth IRA contribution if their income is below 146,000, and married couples filing a joint return can make full Roth IRA contributions if their income is below 230,000. An interesting thing is that we don't all retire at the same time. And a lot of couples, one might retire and the other one might continue to work, or maybe one's never worked. They've been a homemaker and a stay-at-home. So in that case, you can take advantage of what we call a spousal IRA or spousal Roth IRA. And these are special contributions that allow the working spouse to make that has compensation to make a contribution to a traditional IRA or Roth on behalf of the non-working spouse. In essence, the non-working spouse uses the working spouse's compensation as their own for IRA purposes. Now, you can't contribute more than you earn, but as long as your income exceeds $16,000, you can contribute up to $8,000 into two different IRAs. And you might say, well, $8,000 is not a lot of money. Well, it is a lot of money. I mean, it's not a gross amount, but it's a nice sum of money. And will that really make a difference to my retirement? And the answer is absolutely. So here's a quick example. Suppose you're 55 now and you plan to retire in 10 years. The kids have flown the coop. You got the mortgage paid off. You've got some discretionary money. So if you earn 6% a year and you make a $8,000 contribution for 10 years, in 10 years, you'll have over $100,000. But remember, you may need to plan on living till 90 or 95 or longer. So let's say that you leave the account alone and it continues to earn 6%. By the time you reach 85, even if you never put in another dime after that first 10 years, then you've got about $350,000 of tax-free money. So you still think 8,000 doesn't make a difference? It does. And if you're married, you can also do that for your spouse, and you can have twice as much, totally tax-free. So those are IRAs. We also want to make sure that if you're still working and you have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions vary by type of plan, you can generally contribute to your company plan a good bit more money. For example, in 2024, you can contribute up to $23,000 of your salary into a 401k or a 403b or a 457. If you're 50 and older, then you can contribute an additional $7,500 as a catch-up contribution, bringing your total potential plan contribution for 2024 to $30,500. Depending on your plan's provisions, you may also be eligible to receive employer match contributions or a profit sharing contribution. And as you can imagine, putting this type of money away for even just a few years can have a marked impact on your retirement savings. Plus, provided you meet the requirements we just discussed, You can still make a contribution to your IRA or your Roth IRA on top of your company's plan contribution. What people find in retirement is decisions that you make in your 30s and your 40s and your 50s impact you when you're in your 70s and your 80s. And if you're in a relatively low tax bracket, see if your employer plan offers a Roth option. So there are now Roth 403Bs, Roth 401Ks, Roth 457, Roth Simples. So just imagine what would happen if you could contribute $30,000 each year into a Roth 401K. So one of these days you will leave work. And when you retire, you'll likely be faced with one of the major retirement decisions. What do you do with the money you've accumulated in your employer-sponsored retirement plan? In many cases, people roll their money over into a traditional IRA or Roth IRA because they tend to offer greater control over your retirement fund. But that's not the only option, though. And such rollovers are not always the best moves, believe it or not. You may have as many as 6 different options for your employer-sponsored retirement plan. You can see them here on the screen. Each of these potential alternatives offers unique benefits or drawbacks. So it's usually a good idea to discuss your options with a knowledgeable professional so that you can make a good decision that's right for you and your family. So getting money into your retirement account is only half the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half. That is far easier said than done, particularly when it comes to your traditional IRAs, 401Ks, and 403Bs, and other pre-tax retirement accounts. So when you're pre-retiree, putting money into these accounts that's deductible really helps. When you're a retiree, all these pre-retirement dollars have never been taxed, and they're going to be taxed, and they're going to be taxed forever. Anytime money comes out of those, you're going to pay tax on them. And when you leave it to your spouse or family member, they're going to pay tax on it. And at their death, if there's still money in it, whoever the other heirs are going to pay tax on it. In general, withdrawals from these accounts are taxed at ordinary income rates, just like your work income is taxed at ordinary income rate. Your withdrawals are added to your income and taxed at whatever bracket you happen to find yourself in. If your overall income is relatively low, you might have a low tax rate in your withdrawal. But a lot of people are finding that their tax rate is much higher than they thought it would, and your tax rate will be higher, and more of your IRA will end up in Uncle Sam's hands. So here's a quick look at the tax brackets. And we've got single brackets and married brackets. So these brackets are after the standard deduction because so many people are taking that now. And the standard deduction for folks, married couples, is $29,000. Those over 65, it bumps up to 32. For single, it's 14, and it bumps up to 16 for those over 65. But you can see the tax rates and how they impact. And the highest tax rate today is 37%. There are not a lot of people in that bracket, but most of us are in that 10, 12, 22, get into that 24% bracket. But if you look at the history of taxes, they're quite low now compared to where they have been in the past. So one of the troubling aspects of IRA planning is the tax rate for future distributions is unknown. Even if you can project your income with relative confidence, there's no guarantee that the tax rates will remain the same they are now. And actually, our current tax law expires in 2026, and the tax rates will go up. Now, we've got a presidential election coming up. The current law could be extended. It could just die a natural death. We don't know yet. But while it's hard to find someone who doesn't think they pay too much in taxes now, the reality is that the top rates today are pretty low in the historical context. Take a look at this chart. When income taxes were first introduced in 1913, the top rate was 7%, but was just in a few years, it exceeded 70%. Well, it dropped back down after World War II, and it gradually went up so that in the middle of World War II, it hit 90%, and it stayed there. And it was 50 years before it got down below 50% again. So we know that everyone is not in this top rate. In fact, it's only a small percentage of taxpayers that are in it. But with our national debt at all-time highs, a budget that hasn't been balanced in years, I'm not sure that long-term tax rates aren't going to be going up before they go down. To make matters even worse, IRA withdrawals can cost you more than just normal taxes by adding to your income. They can also cause you to exceed thresholds so that you no longer can do certain itemized deductions or personal exemptions or qualify for tax credits. They can increase your exposure to the 3.8% surtax on investment income. And if you take an IRA withdrawal, you might have to include more of your Social Security benefits as taxable income. And Medicare Part B premiums are based on your income, and taking too much money out of your IRA can cause you to have to pay additional Medicare taxes. And that's just the beginning. And we want to try to avoid these issues. And we want you to have a plan to avoid these issues. So one way to minimize the impact of retirement account withdrawals is to not take any money out, just avoid taking it. And this allows your retirement money to grow tax deferred and keep that nasty taxable income off your tax return for as long as possible. You can't put it off forever, though. Once you reach a certain age, the law requires that you begin to take what are known as required minimum distributions, or RMDs for short, from your traditional IRA, from your 401k, from your 403b, from your simple IRA, from your SEP, whatever type plan it is. The same rules apply. The specific age when you must begin taking depends on when you were born. If you were born prior to 1960, you have to start at age 73. If you were born 1960 or later, you have to start at age 75. So you may think back, and just a few years ago, 70 and a half was when you had to start. And then we had Secure Act 1, and it changed at age 72. And recently we had Secure Act 2, and it changed it to the current law of 73 or 75. Now, I don't know if Congress will change this in the future or not. We'll just have to wait and see, but it's something that can be changed. So a final thought before we move on. Remember that you can always take more money out of your plan, but you have to take a certain amount. And how it works is, well, let's talk about how it works. To calculate your RMD, you need to know two things. Number one is your prior year in balance. And number two, the factor for your age from the IRS's tables. So getting your prior in balance is pretty easy. Just look at a statement or your quarter in balance, whatever. Then you use your age to look up your life expectancy. And this table is provided by the IRS. Okay. And then you divide that factor into your balance. So for example, let's suppose you're calculating your 2024 RMD. The first thing you need is your year-end balance. And let's just imagine that your December 31st, 2023 balance was $800,000. That's part one. Next, you've got to figure out your life expectancy factor. Most IRA owners use what's called a uniform lifetime table to calculate their RMDs. So if you look on the screen, I've given you some of the factors. So let's imagine that you turn 75 this year. Now we simply go to the table, we look up the factor for 75, which is 24.6. You divide the 800,000 by the 24.6, And your required minimum distribution for this year is $35,520. And that is subject to ordinary taxes. Okay. So people don't always think in terms of factors or life expectancies. So here's a chart that I thought you might enjoy seeing. I hope it's helpful. It shows the approximate percentage you need to take out of your IRA from age 73 through 90 in order to steer clear of that 25% penalty for not taking money out. If you look, you'll see that each year the percentage you need to take increases. Now, that doesn't necessarily mean that you have to take more money out, because sometimes if you have your money in investments, they go down. So if your account goes down, you have to apply the new percentage of the new factor. But there could be times that you do take out less one year than the next. So it just depends on your gains or your losses from year to year. But over time, Uncle Sam has said, we've given you all these years of tax deferred. Now we want to get paid. And here's how much you have to take out. And when people do their RMD, sometimes they make mistakes. Now, if you have multiple IRAs, you can do what we call aggregate your required minimum distribution. So if you have one IRA that is doing better than another, you can take your total RMD for both IRAs from the lower performing one. And one common RMD mistake that people make is incorrectly aggregating their RMDs between different types of retirement accounts. So let's just say, suppose you have a 401k and an IRA, and you've reached that required minimum date. So after calculating your RMDs for each account, they come out to 12,000 and 10,000 respectively, for a total of 22,000. Now imagine your IRA is earning a lot more money than your 401k. You might be tempted to just pull $22,000 from your 401k, leave your IRA alone, and call it a day. After all, what's the difference? They're both retirement accounts. And whether you take 22,000 from just your 401k or 12,000 from your 401k and 10,000 from your IRA, it's the same impact on your tax return. It's pretty logical thinking. But the tax rules are anything but logical. And they specifically prohibit you from doing this. An RMD from one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k or a 403b. And if you do that, the IRS is going to come back and charge you a 25% penalty on the account that you did not take the distribution from. Another common RMD mistake is aggregating RMDs between spouses. Suppose you and your spouse file a joint tax return. You have an RMD of 15,000 from your IRA, and she has one of 8,000. So you simply take 23,000 out of yours and nothing from hers. The same logic that we used before. It all looks exactly the same on the tax return. But there's no such thing as a joint IRA or a joint 401k. So you must always take your own RMDs from your own accounts. And occasionally, people simply forget to take their RMDs. Either there's some sickness in the family, or there's a celebration, or we're just out of it for a while, different things. If you don't take your RMD, then there is a 25% penalty, yep, 25%. So if you were supposed to take out 10,000 and you didn't, you get to pay $2,500 to the IRS. So what we recommend, and a lot of people live off of their retirement accounts. We understand that. That's what they're designed for. So if you're not taking monthly income, consistent income from your retirement accounts, we recommend that you take your RMDs early in the year. And that way you've got the money if it's needed. Also, that way you don't use non-retirement money that may create taxes and then go, oh, I got my RMD, and you've got to add that to it at the end of the year, and it increases your overall income and it increases your taxes. So either take your RMDs on a regular basis or take them early in the year. So we've got some different strategies to minimize the impact of taxes. And one we mentioned was just avoid taking the distributions for as long as possible. And this allows your money to enjoy that favorable tax deferred status. But it also can help prevent increases in other costs tied to your income. So we talked about taking money may make you pay more on your tax on your Social Security. You may lose some deductions or credits. You may have to pay more in Medicare taxes. And that's true, but there's some major downsides to this approach, though. Most notably, as your IRA gets bigger, so does the problem. Think about it. If your tax bracket remains about the same over time, then as your IRA grows, so does the amount you're eventually going to have to pay to Uncle Sam. Now, this is much different than other things that you might be used to. For instance, let's just say years ago you bought a house for $200,000, and now you've got a $50,000 mortgage. Well, if your house is doubled in value to $400,000, does your mortgage double to $100,000? No, of course not. You get to reap all the benefits from that appreciation. But that's not the way it works with a retirement account, with an IRA or with a 401k or a similar account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share. Plus, by waiting to take distributions for as long as possible, your required RMDs later on will be larger. This could increase the impact of some of those side effects. Thankfully, there's a way to fix this so that, to go back to the mortgage analogy for a minute, you can own your IRA free and clear so that only you benefit from future appreciation. And it's called a Roth IRA conversion, and it's our next savvy planning strategy. A Roth conversion is the name given to a special type of transaction where you move money from your pre-tax retirement account, like an IRA or 401k or 403b, to a Roth IRA or a Roth 401k or a Roth 403b. When you make the conversion, the amount of money you convert is added to your tax return for that year. In other words, that money that was moved is now subject to taxes at whatever your tax bracket happens to be. So let's say that Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. If Jill moves forward with a $100,000 Roth IRA conversion, she'll have to add $100,000 of income to her tax return for this year, and it will be taxed at her current rates. Because this is a big decision and can have a significant impact on your taxes, this is something that's always best to discuss with your tax and your financial advisors beforehand. Now, one of the great things about Roth IRAs are tax-free distributions. So why would you voluntarily choose to make one of these Roth IRA conversions and pay taxes before you have to? Well, there's a lot of reasons. Perhaps the most common reason is one we've already discussed: to pay off Uncle Sam now so that you own your retirement amount free and clear for life. Remember, with a Roth IRA, you have the potential for future tax-free withdrawal of everything in your account. If you're over 59 and a half and you've had any Roth IRA for more than 5 years, then all withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half, but you haven't had a Roth for 5 years, you can still take out the amount you converted tax and penalty free at any time. You just can't take out the growth until it's been in there for 5 years and you're over 59 and a half, tax and penalty free, but you can always take your contributions back, okay? Something else to keep in mind is that unlike Roth IRA contributions, there's no restriction on who can do a conversion. You can't be too old, you can't be too young, you can be working, or you can be retired. There's no minimum amount of income you need or a maximum amount of income you can have. If you want to convert your IRA to a Roth IRA or your 401k to a Roth 401k, there's nothing in the tax rules that will stop you from doing so. The potential tax-free nature of the Roth IRA may also provide you with additional benefit, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? The last one, taxes, is a major concern for many retirees, and one we've talked about a bit. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then that would be an indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact the other things tied to your income. They don't change how much of your Social Security is taxable. They don't limit you from various credits. They don't limit you from taking itemized deductions. So, and they don't increase your Medicare premiums. Okay. Another unique thing about Roth IRAs, and one that many retirees find attractive, is that Roth IRAs have no minimum required distributions during your lifetime. Remember all those RMD calculations and the mistakes, potential mistakes we talked about earlier? They're not an issue. If you have a Roth IRA, during your lifetime, you can take as much or as little as you want. You're not forced to take anything at 73 if you don't want to. You're not forced to take anything at 75 if you don't want to. That means your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning process. So you decide when to take the money if you want to. Again, there's no tax on the interest, the dividends, the growth, the withdrawals. Our money goes to your heirs, and it's tax-free to your heirs. Okay. Now, the Secure Act did do one thing. We used to be able to do a Roth IRA conversion, and if we saw, oops, this might be a mistake, we could recharacterize it. Well, they did away with that. Once you do a Roth IRA conversion, you're now stuck with it. If the tax bill is higher than you thought, too bad. If you accidentally phase yourself out of a credit or create some additional taxes you aren't expecting, too bad. If investments have dropped after you converted them, too bad. Change your mind for any reason whatsoever, too darn bad. So when you're doing a conversion, there are three questions that you need to ask and keep in mind. Do you have a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the resulting taxes? And do you have a reasonable expectations that the benefits of prepaying your taxes like this make sense in your overall plan? And the answer to each one of these should be yes. And we have software in the office that we run for clients to answer all of these questions and make sure that they're happy and familiar with them. So when we do a Roth conversion, there are a lot of different ways to do it. One is you can just simply convert the whole account. And when you do that, you pay taxes on the entire account. But a lot of people don't like that strategy because it's very expensive. So we came up with one we call filling up the bucket Roth IRA conversion strategy. Remember those tax brackets that we looked at earlier? Well, sometimes you can find yourself in the middle of one of these tax brackets, and you have room to add more income without pushing yourself into a higher bracket. For example, in 2024, the 22% tax bracket for married couples filing a joint return goes from $94,000 to $201,000. Suppose then that you file a joint return and your taxable income is $100,000. That means you could add a little more than another $100,000 of income without going into the next tax bracket. making a Roth IRA conversion of the remaining amount could make sense for you. If you plan to convert a sizable portion of your IRA, this approach is often more efficient than converting the full amount at one time. Instead, you make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on the converted money, and it also spreads the taxes out over time. And one of the things that we tell people to look for that can be especially useful is if you're, for some reason, had a low income year, whether you're a business owner or you were sick and you couldn't work the full year or whatever. Let's try to take that lemon and turn it into lemonade. Okay, maybe you normally do the standard deduction, but you had $65,000 of devil work done or something that's going to let you itemize this year. Anything that's out of the ordinary that's bad for your income, okay, might be a good year to do a Roth conversion. Okay. Now, we can't do a Roth conversion once we get into 2025 or 2024. We have to do it in the year. So one of the reasons that we meet with our clients on a regular basis is to see if there's something unusual going on in their life. And if it is, then we want to know about it. If for some reason you haven't heard from us or something happens after we've already reviewed, please let your advisor know, and we can sit down and discuss this. So the last bullet point on here is one of my favorites, and it says after retirement, but before receiving Social Security benefits, pensions, and or IRA distributions. So there are 4 stages of life. And the first stage is accumulation, and that's when you're working. The second stage is what we call transition. And transition begins when you get your last paycheck. It's the beginning of transition. And it starts ending at 70, and it's fully over with at age 75. But retiring and taking Social Security are 2 entirely separate decisions. One does not mandate that the other happen. So when you hit transition and you quit working and your income goes down, then you're in a very low tax bracket, especially if you have not started withdrawing money from your retirement account, if you have not started your Social Security benefits yet, or you've not started pensions if you happen to have one. So this is a good time to take a look and say, look, I remember Chuck said we've got these tax brackets, and if your income's under like $125,000, you never exceed the 12% bracket. Maybe even though I don't need all this money, I should do some conversions to a Roth, or maybe I should pull out more money from my IRA or 401k than I actually need. Some to live on, some to convert, and take advantage of this 12% plan. And then later on, I can start my Social Security and I can start my RMDs. But anytime you take money out prior to the RMD beginning date, it lowers how much money you are forced to take out. And a lot of people are amazed at what they have to take out when they do get there. Okay. So strategy number 3 is there's a good chance that you're going to want to move some money around. Maybe it will be done as part of a Roth conversion. Maybe it will be to make a new investment, maybe to work with a new advisor. Whatever the reason, you should be aware of how to move money and do it at the least costly way to you. In general, there are 2 ways that you can move retirement money. You can either do it indirectly in what's known as a 60-day rollover, or you can move it directly via a rollover of trustee to trustee transfer. And moving money directly is usually the savvy choice. So when you do an indirect rollover, the distribution is payable to you from your 401k or your IRA or whatever. And you have 60 days to get that money into another account. without it being taxed. Now, if the money's coming from an employer plan and not an IRA, there's a federal law that mandates a 20% withholding. There's also a federal law that says you can only do this once a year. So if you were rolling over $500,000 and they sent the money to you, guess what you'd get? 400,000, because 20% of that has been withheld for taxes. And at the end of the year, if you have not put that 500,000 into another plan, you have to pay taxes on all of it. And if you did put your 400,000 into an IRA or another plan, the 100,000, 20% withholding would be taxable to you in that year. So this is not the best way to transfer money. The best way is with a direct rollover trustee to trustee transfers. So this is where the money is simply sent from your old account to your new retirement account. Okay. There's no 60-day rule. There's no 20% mandatory withholding rule, and there's no once per year rule. You can do this every 3 months if you want to. Nobody does. Now, when you do it, often you will receive a check. And this check is payable to your new custodian. So the check might read Company X. We normally use Schwab or Pershing or Fidelity. But let's just say it's made out to Schwab, custodian, FBO, John Smith IRA. The FBO is for benefit of John Smith's IRA. So your old retirement account sent you a check made payable to the custodian. You do not endorse it. It's not made payable to you. It's for your benefit. Take this and give it to your advisor, and the money's deposited into your account. And there's no withholding. It's simple. It's quick. You know where the money is at all times. Whenever you move money, at the end of the year, you will receive a 1099-R for the amount transferred. But when it's done this way, the 1099 will say $100,000 transferred, and then the amount taxable will say zero. So there's no tax ramifications for moving from one retirement account to another if it is a transfer. Okay. So another essential component of IRA planning is to make sure that you coordinate your IRA with your overall retirement plan, estate plan, educational, and financial plan. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor those things into your overall planning into these individually. So some of you may have all your savings in retirement accounts, but many of you probably have some of your savings in non-retirement accounts. If that's the case, one strategy you may want to consider is coordinating your IRA with your overall plan and carefully selecting which of your investments are purchased with IRA money and which investments are purchased with non-retirement account money. Doing so can meaningfully lower your income tax bill. So here's an example of what I mean. Let's imagine you have $100,000 in an IRA and $100,000 in a non-IRA account. Let's also imagine that you want to purchase $100,000 of CDs or bonds with a hypothetical interest rate of 4% and $100,000 of stocks that pay a hypothetical qualified dividend of 4%. And also assume that you plan to live off this and the income these investments generate, and that you're in a 24% tax bracket. Well, what does that look like? Well, in your IRA, you buy stocks that are paying 4% qualified dividends. That $4,000 is income. And when it's paid to you, you pay tax on $4,000. If you're in a 24% tax bracket, that's $960. Now, your non-IRA account, you decide to buy CDs or bonds that are paying 4%. And every year you get that $4,000. And every year it's taxable as ordinary income. And there's another $960. So this is something that we see all the time. People have their retirement accounts loaded with stocks and their personal accounts all in the bank. Okay, it's exactly the same scenario as this. But let's look at strategy number 2. Now, if we take the IRA and we buy those CDs or those bonds or those non-efficient investments that create $4,000. And we're going to pay tax on that money when it comes out. We're going to pay tax on it if we don't buy it in the IRA anyway. So that creates a tax bill of $960. But we take our $100,000 of non-retirement money and we buy stocks paying 4% qualified dividends. Well, qualified dividends and long-term capital gains get special tax treatment. So that $4,000 interest is not taxed at 24%. It's taxed at 15%. It's a 40% discount on taxes. And it's a great way to position your money. Okay. So in both scenarios, you invested exactly the same amount of money in exactly the same investments. You took exactly the same amount of investment risk and you got the exact same rate of return. However, in scenario 2, you get to spend about 20% more money simply by how you position your money. So when it comes to your investments, it's just not what you own, but where you own. So save as much as possible, as early as possible, and utilize tax-aware strategies across tax-deferred accounts, tax-free accounts, and taxable accounts. But proper asset positioning doesn't reduce your rate of return, but it does significantly reduce your current and future income taxes. Another way your IRA planning needs to be coordinated with is your overall retirement plan is your Social Security claiming strategy. The decision of when to file for Social Security is one that too many retirees make without thoroughly evaluating their options first. This is a major mistake and one that in some cases can cost you well over $100,000, sometimes up to $300,000 to $400,000 over the course of your retirement. Now, the decision of when to claim Social Security is a very personal decision and one that varies significantly from person to person and couple to couple. That said, many retirement experts today believe that too many people claim Social Security too soon. Remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live. And benefits are generally increased from one year to the next through cost of living adjustments. Additionally, delaying receiving Social Security benefits past what's called your full retirement age can allow you to earn an additional 8% per year increase in payments until you turn 70 through what are known as deferred credits. For these reasons and more, it may be beneficial to claim Social Security benefits later than you initially planned. So we work with a lot of people. We do a lot of retirement plans. And one of the things that we're looking for is how do we maximize this person's Social Security? And sometimes it's better to start early, but often it's better to start late. And the later you start, the more money you get. And there are reasons for starting early and there are reasons for starting late. But we want you to before you apply, come talk to us so we can make sure you know the decision that best fits you. I know if you're not taking it, you've got to eat in the meantime, right? So, and that might require you to pull money from your IRA in the interim before you start Social Security to cover your current living expenses. And retirees sometimes opt not to do this because they say, what if I die early? I'll have spent my IRA money, which takes away from my heirs, and I've got little to nothing for it. While that's certainly something to consider, I'll give you 2 reasons that you might want to give that approach a second thought. Actually, I'll give you 3. Number 1 is people that defer taking their Social Security, 86% of them get more money than those people that start early. There was a report from the Center for Retirement Research at Boston College that said Social Security is one of the cheapest ways that you can buy an annuity. An annuity is just a systematic liquidation of a pool of money. There are commercial annuities and there's the Social Security, which is an annuity. So it's Think about it. You work from 22 to 62, and let's say you're going to get $2,500. But if you wait 4 more years to 66, you get $3,500. So that's a dramatic jump for just a very short period of time. So the longer you wait, the better off you are. Another reason it can make sense to draw from your IRA in order to help delay claiming Social Security benefits is that Social Security benefits are generally more tax efficient than IRAs. When you take an IRA withdrawal, the entire amount is normally taxable. When you get Social Security, at least 15% of it is tax-free. So anytime you can take money out of a retirement account at a low bracket, and you're going to be in a lower tax bracket if you're not taking Social Security than if you are, it just makes sense to do so. So the key point here is that trading $1 of our income, IRA income, on your tax return for $1 of Social Security will almost always leave you with a lower tax bill and more money to spend going forward. So time to move on to our next strategy, and that's coordinating your IRA planning with your estate plan. And most estate plans, there are really two primary goals. First, make sure that your assets pass to your intended beneficiaries. And secondly, that they're passed to them as efficiently as possible. When it comes to IRAs and 401ks and other retirement accounts, that's done with one particular form. And that form is the beneficiary form. And I can't really emphasize how important the beneficiary form is. And yet, time and time again, people fail to update these forms after major life events, such as birthdays, deaths, marriages, and divorce. Many times people think because they've updated their will, everything is taken care of, but that's not so. The beneficiary trumps the will. So whatever's on your beneficiary is going to be determined where the money goes, not your will. For example, if your ex-wife or ex-husband is named on your IRA beneficiary form, but your will is updated, say your assets go to your children upon your death, guess who's getting your IRA? That's right, your ex. And I can't tell you how often this happens to people. That's why it's so important to keep updated copies of your beneficiary form with your other important estate planning documents. So the Secure Act 2.0 used to just have beneficiaries. The Secure Act 3.0 created 3 different categories. Eligible designated beneficiary, non-eligible designated beneficiary, and non-designated beneficiary. I almost want to cut to the chase through this. And we have non-eligible beneficiaries normally have to take money out by the end of the 10th year that they receive it. And most non-eligible beneficiaries are your children. So with retirement plans that are paid to your children, they can take all the money at one time and pay tax on it. Depending on whether or not you are already taking money out, they may be forced to take RMDs, but by the end of the 10th year, they have to have emptied your IRA account and pay taxes on it. So think about it. Would you rather inherit something that was tax-free or something that was taxable? And if your children are successful, the last thing they want to inherit is a $200,000 or $300,000 asset that is fully taxable to them. The other type of benefit are eligible designated beneficiaries. And basically 95+% of this is spouses. Disabled persons, chronically ill, individuals within 10 years of the decedent's age. So if somebody is single and no children, maybe they leave it to a cousin or friend, they also qualify. But what these people, and if there's minor children under 18, they all qualify. And what they qualify for is what we call the stretch IRA. And they inherit your IRA account and they take money out over their life expectancy, whether it's 20 years or 30 years or 40 years, whatever. Children have 10 years to take that money out. But spouses take it out over their life expectancy. So, and how the stretch IRA works is the eligible beneficiaries are able to take minimum distributions calculated over their lifestyle. And the IRS provides the life expectancies just like they did before. So it's not really called a stretch. That's just something we've given it. But it preserves the tax deferral for as long as possible, and it helps minimize taxes. So if you're eligible for a stretch IRA, that's a good thing rather than being not eligible and having to take the money out in a 10-year period. And spouses get additional benefits. They can do a rollover to their own account. They can treat it as their own, or they can remain the beneficiary of your IRA. So a spousal rollover, Mr. Smith dies, his IRA rolls over to Mrs. Smith. So it moves it into the surviving spouse's own IRA. Funds are treated as though they were always the spouse's, and future distributions may be subject to the 10% early withdrawal penalty if the surviving spouse is not 59 and a half or older. Okay. So rather than doing that, you may want to set up what we call an inherited IRA. An inherited IRA are kept in a properly titled inherited IRA account. And it might say, Mary Smith, beneficiary of John Smith IRA, inherited. And the reason for that is there's a 10% penalty on withdrawals prior to 59 and a half. But one of the exceptions is disability, another exception is death. So if you inherited an IRA, because you can't give them away, the only way you can transfer it to another person is to die. So then that qualifies and it avoids the 10% penalty. So if the wife is not yet 59 and a half, let's just say the wife's 45, then all the retirement money can go into an inherited IRA for the surviving spouse. She has to pay taxes on that money if she needs it to live on, but she does not have to pay a 10% penalty on that money when she takes it out. And when she reaches age 59 and a half, she can switch it from an inherited IRA into a spousal IRA. Well, we've covered a lot of ground today, and I hope I've given you some good food for thought. As you probably realized at this point, IRA planning is a lot more complicated than some people realize. Let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning, from tax planning to investment planning to estate planning. Few people are aware of how critical IRA planning is, and even fewer have taken the time to truly evaluate all the issues and develop a comprehensive solution. Hopefully, we've helped answer some questions for you today, but chances are that you may still have others. So, Betsy, that's pretty much my prepared remarks. Did anybody have any questions?
We have a couple, and a reminder that if you do have questions, put them in the chat box or the Q&A box. One question is, can you contribute to both a regular IRA and a Roth IRA?
Yes, you can. And we'll direct this for people over 50. That's $8,000. What you cannot do is put in more than 8,000. So you can put 6,000 in one, 2 in the other, 4,000 in each, 7,000 in one and 1,000 in the other. You can contribute to both, but you cannot contribute more than $8,000 per person per year.
Okay, very good. If someone has a part-time job in retirement, can they still contribute to an IRA?
You know, we run into this a lot of times. People retire and then they get, maybe they become a bailiff or they find some little job that starts paying them some money. And yes, you can put up to 100% of your earnings into an IRA. So if you've got a part-time job paying you $10,000, some of that's got to go for Social Security. But basically, you could put $4,500 in a Roth for you and $4,500 in a Roth for your spouse. Or into a traditional IRA if you need the tax break.
Very good. I have a retirement plan through my work, but our income exceeds the threshold you mentioned. Can I make any kind of IRA contribution?
Anybody can make an IRA contribution, but I say anybody, if you have earned income, you can make an IRA contribution. If your income exceeds those thresholds we talked about, you cannot deduct it. And when you do that, it becomes a non-deductible IRA. And there's a form that you have to fill out with your tax return. So if you're using a tax preparer, they may ask, did you add money to an IRA? And if you don't qualify, I think it's an 8607 or 8606 is the form that you have to do. The disadvantage in doing that is you put in $8,000, you did not deduct it. And now you've got to track that money the rest of your life. If you don't, you will pay taxes on it when you take it back out. And you can't take it out lump sum. It has to come out pro rata. So if you've got $800,000 in there and you make an $8,000 contribution, 1% of each withdrawal you get is tax free. So it's tough. Now, here's the deal. There's a thing called a backdoor Roth. So it may be possible to intentionally put money into a non-deductible IRA and then a week later convert it to a Roth. Now there's special circumstances, so you need to talk to your advisor about this and make sure we know where we're going from a tax standpoint. But if you don't already have an IRA, if all you've got is a 401k or 403b, those work great all day long. You make a contribution, you don't deduct it, you convert it. What you basically did was you just did an end loop and made a Roth contribution without making a direct Roth contribution. But talk to your advisor about those. They're a little tricky, but they work, and we do a lot of them.
Very good information as always, Chuck. Thank you so much. In the chat box, I put a link to our Retirement Planning Today course that we will be holding. A lot of you have come to us through that course. So if you have friends or family that might be interested, please send them that link. And then if you're watching this video later and you can't see the chat box, the best way to find it is to go to our website, elevate-wealth.com. And if you click the resources menu in the drop-down menu, you'll see Retirement Planning Today course, and there will be a link on that page to that sign up. So we look forward to seeing you there, hopefully. Send your friends and family, and we'll be putting a link to this webinar out on our YouTube channel later today, so feel free to share that as well. Thank you so much, Chuck. We're looking forward to seeing you again soon.
All right. See y'all. Thank you for coming.
Bye. Thank you.